In this video, I'll talk about how to build a portfolio of dividend-paying stocks so they can generate passive income for you. And we're starting right now. Hey guys, welcome to another video from the Keystone Financial Academy. My name is Elliot, and if you're new to this channel, I invite you to join the community by subscribing and turning on the notification bell so you don't miss any of the upcoming videos. I've talked about dividend stocks before on this channel, and you'll find a link to a video that is a beginner's guide to investing in dividend-paying stocks in the description below. I've also talked about how dividend investing is one of the 4 primary sources of passive income, with the other 3 being real estate rentals, licensing and royalties, and business or services. And the link to that video is also in the description below. So now we're really going to get into the details of how to put together a dividend-paying portfolio, what to look for, what to avoid, and the overall strategy to take. And stick around until the end of the video where I'll reveal a unique way of looking at dividend-paying stocks as a high-yield savings account. To kick things off, you of course need an account with the online discount broker in order to be able to buy and sell stocks. I have one with TD Ameritrade, but any one of them is fine, and I'm assuming you already have that set up. Now there are 2 approaches to investing in dividend-paying stocks. The first is to just pick them yourself, and the other is to invest in ETFs and mutual funds that do the picking for you. In this video, we'll focus on when you just pick out your own stocks. Now there are a few things you need to look at when you consider a dividend-paying stock. Number 1 is the stock price, number 2 is the dividend yield, and number 3 is the actual annual payout. There are certainly other factors to look at, but let's focus on just these 3 for now, and we'll use Coca Cola, a well-known dividend-paying stock, as an example. Now the price of the Coca Cola stock is pretty self-explanatory, and it's around $53 at the time of the taping of this video. So let's then look at the dividend yield. It stands at 3.05%, which is of course 3.05% of 1 share of a Coca Cola stock. If you do the math, that works out to about $1.64, which is exactly what the annual dividend payout is. Now that is per share and annual, meaning that if you own 1 share of the Coca Cola stock, you will get about 41 cents each time the stock pays a dividend, which is 4 times per year since Coca-Cola pays quarterly, and at the end of the year you will get the $1.64. Now it's very tempting to shop around for dividend-paying stocks by just going for the highest possible dividend yield. But here you have to be careful, and that's one of the central themes of this video. As it turns out, you don't just want to go for the highest yield you can find, nor necessarily settle for the lowest. What you want to do is put together a portfolio that balances out risk and reward. To see how risk and reward plays into dividend stock investing, you have to understand that the dividend yield is loosely tied to the inherent underlying riskiness of the stock. Dividends are paid out as a reward to investors. And if a company's fundamentals are not that strong, yet it still wants to attract investors and their money, it usually means it'll need to raise its dividend yield to sort of sweeten the pot to attract more investors. Conversely, if a company is very strong and its stock is increasing due to its very strong fundamentals and a strong industry that it's in, then investors will buy the stock anyway, and there's no need to give away an excessively large dividend payment. So the company will keep the yields relatively low. You can see this play out in the market if you look at a few companies that are rock solid and are leaders in their field and are profitable, such as in consumer staples. And then you compare them to a few others that are in a more volatile industry and may not be in such great shape, such as in the energy sector. As an example, take Johnson & Johnson, Procter & Gamble, or even Coca Cola that we looked at earlier. All 3 are very stable and profitable, and their dividend yields are 2.69, 2.30, and 3.05% respectively. But of course, these are not exactly earth-shattering payouts. Now compare this with an energy stock such as ExxonMobil that pays out 8.35% dividend, or a slow growth telecom one like AT&T that pays out 7.04%, or even a moderately risky real estate investment trust like Iron Mountain that pays out nearly 8.5%. In all these cases, you have companies whose shares may lose value, or their industry is growing very slowly or shrinking, or faces some other troubles, hence the much higher dividend payment. Now with REITs, it's a little bit of a different story because they are required to pay out a a certain percentage of the profit as a dividend, but they are still considered relatively risky. Additionally, with stable and profitable lower dividend paying companies, you have the stability of the dividend itself in the sense that the company doesn't cut it or stop it, but actually even raises it from year to year. With high risk companies, the dividend can be in jeopardy and may even disappear completely. To see which companies have the longest track record of not just keeping but also raising the dividends, I consult my trusty US Dividend Champions database. It's a document I talk about quite a bit in my dividend videos, and you can download it for free via the link in the description below. So after all of this background and explanation of what to look for, how would you as an investor actually put together a dividend paying portfolio? This all really boils down to the classic risk versus reward. Decide exactly how much risk you're willing to take on and how much of a return you'd like to see on your investments. If you're risk averse and want a safe portfolio that'll help you sleep at night, so to speak, then stick to the dividend champions such as 3M, Johnson & Johnson, Colgate-Palmolive, Procter & Gamble, Coca Cola, Walmart, and dozens of others like them. Your returns will average in the 2 to 3% range, but it will be a very safe portfolio. Now keep this type of portfolio in mind. We're going to come back to the end of the video regarding that extra bonus information I wanted to pass along. Now if you want to get a high return but not go too extreme, you should shoot for a 4 to 7% type of return. And then you have a number of somewhat higher risk stocks to choose from the finance, telecom, and legacy tech industries such as United Bancorp, AT&T, and IBM, among many others. Now if you're looking to earn above 7%, maybe 8, 9, or even double-digit returns, you will get into much more risky investments, such as what energy and some REITs offer, with companies like ExxonMobil, Kinder Morgan, and Iron Mountain, among many others. Now to me personally, for my portfolio, I don't see a huge downside to buying the riskier and higher paying dividend stocks, as long as they're issued by larger companies and the stocks are liquid, meaning there's a high volume of trading activity and the bid-ask prices are relatively close together. What all of that means is there's a lot of shares of the stock being traded and there's a fairly good agreement on the buy and sell price. This of course means I can easily sell off the stock if the dividend gets cut, reduced, or discontinued, as the dividend is the primary reason I'm holding that stock in the first place. My personal investment target is in the 6 to 7% range, and that is an average, so some of my stocks are higher and therefore pay more and are a little bit riskier, and some are lower paying and safer. I keep an eye on the portfolio on a weekly basis and adjust by selling off any stocks that cut or discontinue the dividend, but overall this is a pretty rare occurrence as I tend to pick the stocks very carefully. Now keep in mind that the stocks themselves do appreciate in price as well, but most dividend stocks of course don't go up that dramatically, which is much more typical of a growth investment stock. However, their appreciation, however much it is, can be counted in the total return, so it's not just the dividend income itself. Once you pick and choose the dividend stocks you're interested in, keep in mind the payment schedule, with important milestones such as the ex-dividend date, which is just the date that you must own the stock by in order to be eligible for the next dividend payment, and of course the actual payment date itself. Dividend stocks pay out typically quarterly, but sometimes monthly. It just depends on how the company decides to do it. You must also decide what to do with the dividend payments themselves. Your options are typically to just keep the money or reinvest it right back into stock. Either do it by yourself or with something called a dividend reinvestment plan or a DRIP. Finally, don't be discouraged if the money you make from the dividends are not that large in the very beginning. This is definitely not a get-rich-quick scheme, and it takes time and a lot of investing before you can build up a really good income stream. As a general guideline, if you are targeting a 7% investment return on your dividend income, you would get $70 for every $1,000 that you invest. This of course grows significantly over time, and once you invest $10,000, you're now making $700, and when you invest $100,000, you're pulling in a very substantial $7,000 of passive income every year. Okay, finally, as promised, I wanted to mention a unique way of looking at dividend paying stocks as a high yield savings account. This only applies if you invest in the super safe 2 to 3% paying stocks that I mentioned earlier in the video. In this case, you're earning a far better return on your money than any savings or money market account while being exposed to relatively little risk. This approach is definitely not for everyone, and keep in mind and your money is not protected by the FDIC as it would be in a checking or savings account or even a money market account. But for those that have significant savings and want to earn far more than any of these above accounts give you, this might be a really good approach. Alright, so these are the essentials of how to build a dividend-paying portfolio for passive income. As always, be sure to subscribe and hit that like button and let me know in the comments below what topics you would like to see me cover. Thanks for watching, and I will see you all soon.